Meridian Financial Bank, that served 4 million customers across 8 states for 97 years, just closed its doors. Not because of a cyber attack, not because of fraud, not because they ran out of cash. Federal Reserve Chair Jerome Powell said it himself at yesterday's emergency meeting. The bank became mathematically insolvent due to a catastrophic mismatch between their assets and regulatory requirements that we failed to prevent. I'm Elizabeth Carter, and this is the only official channel for independent investigative journalism. Before we go any further, I need you to do something right now. Hit that subscribe button, click the notification bell. Leave a comment below telling me if you've noticed your local banks closing branches this year. Share this video with everyone you know, because what I'm about to show you is happening in real time across America, and it's spreading faster than anyone wants to admit. The collapse of Meridian Financial represents the 11th largest bank failure in American history. $91 billion in assets, gone. But here's what nobody is saying out loud. This was not an isolated incident. This was the inevitable result of a regulatory framework that prioritized political ideology over mathematical reality. Treasury Secretary Janet Yellen admitted in a closed-door briefing yesterday that the administration knew about systemic vulnerabilities in the banking sector, but chose to pursue deregulation anyway. Translation: they saw this coming and did nothing to stop it. What I'm about to show you tonight connects this single bank failure to an $8.5 trillion crisis that has been building for 18 months. The dominoes started falling the moment this administration decided that bank supervision was optional. And tonight, I'm going to walk you through exactly how we got here, who's about to eat the cost, and why this is just the beginning. Think about that. The people who were supposed to protect your money knew this was coming, and they chose to look the other way. That should make everyone angry. The Federal Deposit Insurance Corporation has been tracking 59 banks on their problem list. 59 institutions holding hundreds of billions in assets are teetering on the edge of insolvency. But instead of addressing the root cause, this administration spent the last year dismantling the very safeguards designed to prevent exactly what happened to Meridian Financial. Here's the accountability question I want you thinking about as we dive deeper. When the people in charge of protecting the banking system actively remove the protections, who is responsible when the system collapses? Because this story isn't over. It's being written right now. And what happens next depends on whether we're willing to connect the dots between policy choices and their inevitable consequences. Stay with me. What comes next is going to show you exactly how a single regulatory decision created a cascade of failures that puts every bank account in America at risk. The numbers don't lie, and tonight I'm going to show you exactly how massive this crisis really is. $395 billion in unrealized losses are sitting on bank balance sheets right now. That is bigger than the GDP of South Africa. And that number only went down $17 billion last quarter, which means we are nowhere near the bottom of this hole. Dr. Sarah Chen, banking analyst at the Federal Reserve Bank of New York, told Bloomberg last week, the capital gap under our stress scenarios has improved from $5 billion to just under $2 billion, but under more severe economic conditions, we're looking at a potential shortfall of $161 billion across the banking sector. Translation: when things get bad, American banks don't have enough money to survive. Let me break down the domino chain that's already in motion. First domino, commercial real estate values collapsed due to remote work policies. Second domino, smaller regional banks that loaded up on commercial real estate loans started showing massive losses on their books. Third domino, rising interest rates turned those paper losses into real insolvency when customers started withdrawing deposits faster than banks could liquidate assets. Here's what that means in plain language. Your local community bank probably has a huge chunk of its money tied up in office buildings that nobody wants to rent anymore. When people need their money back, the bank has to sell those buildings at fire sale prices. And when you're forced to sell assets for 70 cents on the dollar, you go broke fast. The Federal Deposit Insurance Corporation is currently monitoring 59 banks on their official problem list. 59 institutions representing over $82 billion in combined assets. That represents 1.3% of all banks in America, which sounds small until you realize that's triple the normal rate for non-crisis periods. But here's what nobody is saying out loud. These aren't just small community banks in struggling rural towns. We're talking about regional institutions with hundreds of thousands of customers, business lending portfolios that keep local economies running, and deposit bases that represent the life savings of working families who thought their money was safe. Michael Torres, a former FDIC examiner who worked on bank resolutions for 15 years, admitted to the Wall Street Journal, "We're seeing stress indicators that mirror the lead up to 2008, but this time the underlying cause is policy-driven rather than market-driven, which makes it both more predictable and more preventable." Think about that. This crisis was created by choice, not by chance. And it gets worse. The Basel III capital requirements that were supposed to force banks to hold more reserves against potential losses, those rules that could have prevented exactly what we're seeing right now. The Trump administration abandoned them completely in favor of what they called business-friendly regulation. Industry analysts warned that eliminating enhanced capital standards would leave the banking system vulnerable to exactly the scenario we're living through right now. Dr. Elizabeth Warren, banking specialist at the Congressional Budget Office, published a report in March showing that reduced oversight would increase systemic risk by forcing banks to choose between profitability and stability. Translation: they chose profits over your security. The human cost of these policy choices is about to become very real for millions of Americans. When banks fail, people lose their jobs. Small businesses lose their lines of credit. Retirees lose access to the local branches they've relied on for decades. And communities lose the institutions that kept money circulating in the local economy. But wait, there's something they're not telling you about how we got here. The regulatory framework that could have prevented this crisis wasn't eliminated by accident. It was dismantled systematically, piece by piece, by an administration that prioritized campaign promises over financial stability. And that story is what we're diving into next. On August 7th, President Trump signed an executive order titled Guaranteeing Fair Banking for All Americans. The administration called it a victory for business freedom. What they didn't tell you is that this single piece of paper dismantled the early warning system, designed to prevent exactly what happened to Meridian Financial. Acting Comptroller Rodney Hood issued a directive to bank examiners on March 20th. Focus on measurable, objective risk categories rather than subjective notions of reputation risk. On June 23rd, the Federal Reserve Board announced that reputational risk will no longer be a component of examination programs. Translation: banks no longer have to worry about whether their business practices might blow up the financial system. Let me show you the second domino chain that created this crisis. First domino: Trump administration eliminates reputation risk from bank supervision. Second domino: banks increase high-risk lending because regulators can't flag dangerous practices as reputational concerns. Third domino: systemic vulnerabilities multiply across the banking sector because individual bank risks are no longer evaluated for broader economic impact. Here's what that means in plain language. Reputation risk was the regulatory tool that let examiners say your lending practices are mathematically sound, but could destabilize the broader economy if other banks copy them. Without that tool, regulators became blind to systemic threats that only emerge when multiple institutions make the same risky bets. But wait, there's something else they're not telling you. The Basel III capital requirements that were supposed to force banks to hold more reserves against potential losses. Remember those rules I mentioned that could have prevented this crisis? Treasury Secretary Steven Mnuchin announced in February that the administration would not implement enhanced capital standards because they would reduce bank profitability and restrict lending to American businesses. Translation: they chose short-term profits over long-term stability. Dr. Anat Admati, banking expert at Stanford Graduate School of Business, warned Congress in March, abandoning capital requirements while eliminating reputation risk oversight creates a perfect storm where individual institutions can pursue profitable but systemically dangerous strategies without regulatory intervention. Think about that. They didn't just remove one safety net, they removed multiple safety nets simultaneously. And it gets worse. The administration appointed former bank executives to key regulatory positions with explicit mandates to reduce compliance costs and streamline oversight. Acting FDIC Chairman Martin Gruenberg was replaced by industry insider Thomas Curry, whose first official act was suspending enhanced supervision requirements for banks with assets between $50 billion and $100 billion. Those are exactly the size institutions that are failing right now. Here's the third domino chain that connects regulatory capture to economic catastrophe. First domino: industry executives take control of regulatory agencies. Second domino: compliance requirements are eliminated or weakened based on industry preference rather than safety analysis. Third domino: banks optimize for profitability using strategies that regulators can no longer evaluate for systemic risk. Fourth domino: multiple institutions pursue similar high-risk strategies simultaneously because individual risk assessment no longer considers broader economic impact. Translation: they turned the banking system into a casino and removed the house limits. Federal Reserve Vice Chair for Supervision Michael Barr testified before Congress in April that reduced oversight had already created measurable increases in systemic vulnerability. His exact words: "We are observing risk concentrations and correlation patterns that would have triggered enhanced supervision under previous regulatory frameworks." Let that sink in. The people responsible for preventing banking crises were watching the crisis develop in real time and chose not to intervene because their regulatory tools had been eliminated. And here's the irony that should make everyone furious. The Fair Banking Executive Order was supposed to protect banks from political interference. Instead, it created the exact conditions that destroyed Meridian Financial and put 58 other institutions on the brink of collapse. The law of unintended consequences is not theoretical. It is playing out in real time across every community in America that depended on stable local banking. But this is where the story becomes truly devastating. Because the people who are paying the price for these policy choices aren't the executives who lobbied for deregulation or the politicians who signed the orders. The price is being paid by working families who trusted that their money was safe and their banks were supervised. What I'm about to show you next is the human face of regulatory failure. Real people whose lives are being destroyed by decisions made in Washington boardrooms by people who will never experience the consequences of their choices. Let me tell you about Margaret Chen, third-generation banking family. Her grandfather started as a teller at Meridian Financial in 1927, worked his way up to branch manager. Her father spent 42 years there, retiring as regional vice president. Margaret herself had been with the bank for 28 years, most recently as head of commercial lending. Margaret told reporters outside the locked bank building yesterday, "I helped build relationships with local businesses for nearly 3 decades. I knew every major employer in this county personally. They called me Friday afternoon and said, 'Don't come in Monday.' The FDIC has taken control. 28 years of my life, and I found out my job was gone from a voicemail." Let that sink in. And Margaret is not alone. In the last 18 months, 11,000 bank employees have lost their jobs due to institutional failures directly connected to regularity rollbacks. That is bigger than the entire workforce of some small cities. Now let me tell you about David Rodriguez, small business owner who operated Rodriguez Auto Repair for 16 years. His entire operation depended on a line of credit through Meridian Financial that he'd maintained flawlessly for over a decade. When the bank closed, that line of credit disappeared instantly. David said, "I had 3 employees, steady customers, contracts lined up for the next 6 months. But without access to working capital for parts and equipment, I can't fulfill existing orders. I'm not just losing my business, I'm laying off people who have families to feed, because some politician in Washington decided bank oversight was optional." Think about that. a functioning small business destroyed not by market forces or competition, but by regulatory decisions made by people who will never set foot in his community. Rodriguez Auto Repair employed 4 people, including David. It served over 300 regular customers. It was the only full-service auto shop within 20 miles for a rural community that depends on reliable transportation for work and medical care. All of that economic activity just vanished because the institution that provided working capital was allowed to fail preventably. Let me tell you about Eleanor Hartwell, 74 years old, retired schoolteacher. She kept her pension and social security payments in a savings account at Meridian Financial because it was 3 blocks from her house and she'd banked there for 51 years. The FDIC will eventually cover her deposits, but Eleanor doesn't drive anymore and the nearest alternative bank is 40 minutes away by car. Eleanor told local news, "I don't understand computers or online banking. I need to walk to my bank and talk to people I know. Now they're telling me I have to learn a whole new system at my age or drive to the next county every time I need to deposit a check. This isn't just about money. This is about independence. That is not abstract. That is real." And Eleanor is not alone. Meridian Financial served as the primary banking institution for over 40,000 seniors across 8 states, many in rural communities where branch closures mean complete loss of accessible banking services. Now let me tell you about James Mitchell, frontline bank employee who discovered the insolvency on the day of closure. James worked as a loan officer at Meridian Financial for 12 years. He processed mortgage applications, small business loans, and personal credit lines for thousands of families. He thought he was helping people build financial security. James said, "I came to work Friday morning thinking it was a normal day. By 10 a.m., federal regulators were walking through the building with clipboards. By noon, they were telling us to pack our desks and turn in our key cards. I spent 12 years helping people in this community achieve their financial goals, and I learnt my employer was insolvent from a stranger in a federal jacket." Think about that for a moment. James represents over 800 Meridian Financial employees who discovered their workplace was mathematically unsustainable only when federal agents arrived to shut it down. These are people who processed loans, managed deposits, and provided financial guidance while having no idea their institution was operating outside sustainable parameters. The pattern here is devastating. Margaret lost her career, David lost his business, Eleanor lost her independence, James lost his sense of professional purpose. All because policymakers decided that protecting banks from oversight was more important than protecting communities from bank failures. In the last 2 years, 47 banks have closed their doors due to insolvency directly connected to reduced regulatory oversight. That represents 112,000 jobs eliminated, 850,000 customers forced to find alternative banking services, and incalculable damage to community economic ecosystems that depended on stable local financial institutions. But wait, there's something they're not telling you about how predictable this human cost really was. Every single story I just told you could have been prevented. The Federal Reserve Bank of New York published a banking vulnerability assessment in November that specifically warned about the exact scenario we're living through right now. The capital gap calculations, the commercial real estate exposure risks, the systemic correlation patterns, it was all there in black and white 8 months ago. Dr. Beverly Williams, lead economist on the vulnerability study, told the Financial Times, "We identified elevated systemic risk concentrations that would require enhanced supervision under traditional regulatory frameworks, but our policy recommendations were not implemented due to administration priorities favoring reduced compliance costs." Translation, they saw the warning signs and chose to ignore them. The FDIC issued 3 separate alerts between January and June about increasing risk concentrations in regional banking portfolios. Alert 1. Commercial real estate loan concentrations exceeding safety thresholds. Alert 2. Interest rate risk management deficiencies across multiple institutions. Alert 3. Inadequate capital buffers relative to asset quality deterioration. Each alert included specific recommendations for enhanced supervision and mandatory stress testing. Each recommendation was declined by regulatory leadership, citing executive orders prioritizing business-friendly oversight. Here's what that means in mathematical terms. The banking system was operating with a safety margin of 2% when industry standards require 8%. That is like driving a car with brakes that work 25% of the time and calling it safe because most trips don't require emergency stopping. Professor Jonathan Hayes at the Wharton School published a study in April, predicting that reduced oversight combined with commercial real estate exposure would trigger a cascade of regional bank failures beginning in the third quarter. His model identified 12 specific institutions as highest risk based on asset composition and regulatory gaps. Meridian Financial was number 3 on that list. Dr. Hayes told CNBC, "The mathematical relationships between policy changes and institutional vulnerability are not mysterious. When you remove supervisory tools while maintaining risk exposures, you create predictable failure scenarios. This was not a matter of if, but when." Think about that. Academic researchers using publicly available data predicted this crisis more accurately than the regulators who were supposed to prevent it. Compare our situation to Canada, where enhanced supervision requirements were strengthened rather than eliminated over the same time period. Canadian banks maintain capital ratios averaging 12% compared to our 4%. 0 Canadian banks have failed in the last 3 years. 0. The European Union implemented stricter Basel III requirements in response to post-pandemic risks. European bank failure rates decreased 40% over the same period that American failure rates increased 200%. This isn't about different economic conditions or market forces. This is about policy choices that prioritized ideology over mathematics. Here's the timeline of missed intervention opportunities. March, Federal Reserve identifies systemic vulnerabilities, recommendations ignored. April, academic study predicts specific institutional failures, warnings dismissed. May, FDIC proposes enhanced supervision triggers, proposals rejected. June, international banking analysts warn about American regulatory gaps, concerns minimized. July, industry insiders begin reporting stress indicators, reports suppressed. August, Meridian Financial collapses, exactly as predicted. But here's what should terrify everyone. The underlying conditions that created this crisis are getting worse, not better. Commercial real estate valuations continue declining. Interest rate pressures continue intensifying. The 58 banks still on the FDIC problem list are operating under the same regulatory framework that failed to save Meridian Financial. Dr. Patricia Chen at the Congressional Budget Office projects that current trends will trigger 6 to 12 additional institutional failures within the next 18 months, unless enhanced supervision is restored immediately. 6 to 12 more Meridian Financials. 6 to 12 more Meridian Financials losing their careers. 6 to 12 more David Rodriguez businesses destroyed. 6 to 12 more Eleanor Hartwells losing their independence. The mathematical inevitability is undeniable, and the human cost is about to multiply exponentially, unless someone takes responsibility for fixing what should never have been broken in the first place. Here's the accountability question I want you to answer in the comments. When an administration removes banking safeguards despite expert warnings, then those exact warned-about failures destroy people's livelihoods. Who bears responsibility for the human cost? Is it the economists who published the warnings? Is it the regulators who wanted to implement protections? Is it the banks that operated within the rules they were given? Or is it the political leadership that chose deregulation over mathematical reality? I want a yes or no answer in the comments. Do you hold the Trump administration accountable for policy choices that directly caused preventable banking failures? Because this isn't about partisan politics. This is about cause and effect. The Meridian Financial collapse is not an isolated incident. It is the first domino in a sequence that was set in motion 18 months ago when this administration decided that protecting banks from oversight was more important than protecting community from bank failures. Margaret Chen didn't lose her 28-year career because of market forces. She lost it because political ideology overrode financial mathematics. David Rodriguez isn't closing his auto repair shop because of competition. He's closing it because regulatory capture eliminated the safety nets that kept his financing stable. That is the human cost of treating banking supervision like a political preference instead of an economic necessity. Here's what I need you to do right now. Share this video with everyone you know, because this story is not over. The 58 banks still on the FDIC problem list are operating under the exact same regulatory framework that failed to save Meridian Financial. The warnings are still being ignored. The mathematical relationships that created this crisis are still in effect. This is the only official channel documenting the connection between policy choices and their inevitable consequences. There are imitators trying to copy this investigation, but this is where you get the documented evidence, the expert testimony, and the timeline that connects regulatory decisions to human impact. Hit that notification bell, because I'll be covering every stage of this crisis as it develops. Every bank closure, every policy response, every attempt to blame this catastrophe on anything other than the deliberate elimination of financial safeguards.